Hello, and thanks for joining us for episode 4 of our transition series. In today's episode, we'll demystify the right of use asset and lease liability and discuss the basics of each. With me today is Sarah O'Sullivan, Director of Product at Lease Query. Hey, Sarah.
Hey, Emily.
So we know that the main driver of ASC 842 is to bring all leases onto the balance sheet. And so let's talk about how exactly we do that. We know we have a lease liability and a right of use asset, but what exactly goes into those two amounts? Let's start with the lease liability.
Yep, you're exactly right, Emily. So obviously with adopting ASC 842, we're now going to recognize and present on the balance sheet this new lease liability and its corresponding right of use asset, an ROU asset. And this is the big challenge that we're all facing, is how to calculate those amounts and get them on the balance sheet. And yes, you're right. Starting with the lease liability is important because that's actually the first step. Knowing that amount is the first step to measuring your lease asset. So you want to do the lease liability first. The lease liability calculation, it's relatively straightforward. It's measured as the present value at your commencement date of your future lease payments. So lease payments that have not been paid yet. And since this is a present value amount, a discount rate is required for this calculation, but I know that's going to be a topic for a future podcast. So we can just focus on the rest of the calculation, which is essentially determining lease payments. What are these lease payments that I need to include? And there are actually several types of payments that may exist in your lease arrangements that are considered lease payments and that you need to be including in your present value calculation. So first off are fixed payments. And these are the really straightforward payments we automatically think of when we think of leases, your rental payments. They're fixed amounts that are known and scheduled in the lease contract itself.
Got it. So payments you know about. So that would be basically your rent, and in general, things that aren't reconciled on any sort of frequency, right? So those are your fixed payments.
Right. And they're going to be pretty explicit and clear in the document and your contracts when you're reading through them. The second one are a type of variable payments, specifically those variable payments that depend on an index or a rate. So an example of this type of payment is if you have a lease agreement and it states that your rental payment amounts, they're going to change annually each year based on an inflation rate, for example, or some other sort of index. This type of payment structure, it means that at commencement, you don't know the actual future amounts that you're going to pay because you don't know how that rate or index that it's based on is going to change over time. But for your initial measurement of the lease liability, what you're going to do is you're going to determine your payments based on that index or rate that is in effect at that commencement date. So you'll essentially assume that that index or rate stays the same throughout and calculate your payments based on that.
Okay. Is there anything else?
Yeah, so payments for exercising a purchase option or a termination option. You should also be including these in your calculation. This is if you as a lessee, you've determined that option is reasonably certain to be exercised. So this goes back to when you're reviewing your contracts and analyzing your lease term. If you have determined that you're reasonably certain to exercise a purchase option or a termination option in the future, then if there is any cash payment associated with exercising that option, then you should also be including that in your combined sum of lease payments.
And that reasonably certain threshold or concept is something that we discuss in a future podcast. So listeners can tune into that one as well.
And then last would be a lessee should include any amounts that they are probable to be owed related to residual value guarantees.
Okay, and so residual value guarantees, we see these a lot with car leases, right? Like you can't run the car into the ground. You have to return it to the dealer with a certain value left so that they can sell it or release it to someone else.
Right. So you might have to be considering there if you need to hit that certain value, are you going to have to make up for any type of gap with cash payment? And again, you're going to read your contract. You're going to know if you have a residual value guarantee that you're obligated to. So once you have all of these, whatever these type of payments you have, and you've compiled all of that data, you're going to put it into your present value calculation, and the resulting amount that you get from that calculation, that is going to be your lease liability for the lease in question to record at commencement. So that's at commencement. When you are you're getting ready to adopt 842 and you have been account and you have existing leases that you have been accounting for under ASC 840, and now you need to transition them to 842. Well, what you're going to include are your payments that are still remaining, not at commencement, but at the beginning of that earliest period that you were planning to reflect the new 842 accounting. So I know we've talked before about the transition methods that are available. If you've decided that you're going to restate your prior periods, your comparative periods, then you want to use whatever remaining lease payments are still existing at the beginning of that prior period that you're restating, the earliest period that you're restating. If you've decided that you're only going to reflect 842 in your current year of adoption, then you're going to use the remaining payments as of the beginning of that current year that you're adopting.
Okay, so now that we're all clear on how we calculate the lease liability, let's shift gears and talk about this right of use asset.
Yep. So you need to have the asset that goes with the liability, and you're already part of the way there, because as mentioned before, calculating and knowing that lease liability amount is actually the first step to calculating your asset balance. So what you're going to do, you take that initial lease liability balance and you make some adjustments to it, assuming certain situations if they apply. And these possible adjustments, they would include initial direct costs or lease prepayments that you've made, which increase the asset balance, and incentives received at or before the commencement date, incentive payments you've gotten from your lessor, and those are going to decrease your asset balance. So to wrap that up kind of in a formula format, you start with your calculated lease liability balance, you add initial direct costs you've incurred, you add any lease prepayments that you've already made, and then you subtract out incentive payments that you have received.
So if I've been operating under ASC 840, I could potentially have some prepaid rent or deferred rent balances on my balance sheet. What happens to those when you transition?
Yeah, and this is a really good point, and something that I think sometimes trips people up and really is something that they need to be thinking about when they are doing their transition to 842, and so that it doesn't surprise them when they get there. So what we're talking about, what you just mentioned, is that under ASC 840, when you have a lease and the lease payments are not constant over the term, you are required to record that lease expense as a straight line amount each period. And so that results in recording the same expense amount regardless of what cash you're actually paying. And any difference in the period between that straight line expense amount and the cash you did pay, you're going to apply that to an offsetting prepaid or deferred rent, depending on which direction that goes. ASC 842, it does not change this requirement. So you still are recognizing lease expense for your operating leases on a straight line basis. What it does, though, is it does change how that offsetting prepaid or deferred rent balance is presented. So previously, what we're used to is we see this balance on your balance sheet, as part of your other general assets or liabilities. Now with ASC 842, it is going to be incorporated into your right of use asset balance. So essentially your asset balance is going to be net of these type of straight line adjustments. It's a concept I had to think through, and it may take a moment to get used to that change. But what this means is that when you calculate your new ROU asset balance, it already incorporates these straight line adjustments. And so what you're going to need to do when you're booking your transition entries is you need to make sure that you reverse off any of the existing prepaid or deferred rent balance that you've been carrying in your ledger at that time.
Well, thanks for walking us through that, Sarah. We hope you found today's episode helpful. As a reminder, we have many other episodes in this transition series to help you simplify this complex accounting. Join us for our next episode, where we'll talk about the incremental borrowing rate.